sound that's in the air. It's rock and roll. 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 It's rock and roll.
Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of the Real Investment Show. That's right, Danny Ratliff joins me today along with just talking about kind of everything in general today. And the big concern right now is recession risk. Just wrote an article basically last week talking about recession risk so far. Really not as high as some of the economic data, or back that up. Not as high as a lot of the media headlines suggest. Economic data still supportive of a slowing economy, but not a recessionary one just yet. But there's certainly some indications out there that the consumer is coming under a lot of pressure, and something that we'll be talking about more in kind of the days ahead. But one of the interesting things yesterday was the consumer confidence report came out. Now, we talked about sentiment, and that when markets are going up, everybody gets super excited about the markets. Everybody's excited about the markets, etc. It's all good, man. Just throw your money in the stock market. It's just going to make you more money. You don't even have to work, right? Just invest in the stock market. That's all you got to do. A couple of months ago, the consumer confidence showed the highest level of confidence ever on record of consumers expecting higher stock prices in the next 12 months. Pretty amazing. And that was right towards the peak of the market. After this 10% correction, we've talked about how investor sentiment has gotten extremely negative across the board, whether it's institutional investors, retail investors, very, very negative sentiment about the markets. Well, the consumer confidence report showed yesterday that those consumers who were so excited about higher stock prices in the next 12 months, completely gone. Completely reversed it. Largest drop on record for consumer confidence about higher stock prices in the next 12 months. And it was just a 10% correction. Look, I know it was a fairly decent correction. We've been talking about this for a couple of months now, but it's just part of the market cycle process. But it is very fascinating about how fast sentiment changes. But sentiment is so important, right? We cannot dismiss sentiment. And this is something we're going to be talking about more in the newsletter this weekend, is that sentiment and money flows. Those are the two things to really pay attention to, because when money flows are reversing, right, stock prices are typically going to fall because you have more sellers than you have buyers. That's why money flows are reversing. But sentiment, not so much in the middle, but extremes are really, really good contrarian indicators for the markets, historically speaking, right? Does that mean it's always going to be the case? No. Right? There's always this time is different, right? And there's sometimes that these times are actually different. Good example, right? Over the last couple of years, we've talked a lot about recessionary indicators, right? Inverted yield curves, leading economic indicators, manufacturing indexes, etc., all pointing into very recessionary territory, but never had a recession, right? Lots of calls for a recession, but never actually had the economic recession. And of course, those indicators have almost perfect track records for predicting recessions historically. Now, we haven't had one yet, but so far, those have had faulty records. And again, first time in their history, but again, we had just massive amounts of monetary stimulus coming into the economy that helped the economy continue to grow. And we're finding out more and more now about actually how much was kind of going on behind the scenes in terms of the last administration of money getting funneled into various aspects of the economy, which was keeping the economy afloat. And that's okay, right? Nothing wrong with that. But it was just a massive amount of stimulus, but that kept the economy from falling into a technical recession, even though all the indicators, suggested that was the case. Now, does that mean that we will never have a recession again? Absolutely not. And the next time those indicators indicate a recession, they're probably going to be accurate. So again, we'll look back in history, as we move forward next 20 years, we'll look back and it's like, well, this has got a perfect indicator except this one time, right? So that's going to be the case with a lot of these indicators, and there's going to be a big catch up here. But, again, there's certainly concerns. Consumer credit is under a lot of pressure. Delinquency rates are starting to rise pretty sharply with consumers. Consumer confidence about job security falling sharply. Consumer confidence about future incomes declining. Those do not suggest stronger economic growth or higher rates of inflation. Those are very much in line with our expectations of slower economic growth this year. And again, something we're going to write about more in the newsletter this weekend in particular. But this is really going to kind of shape out what the rest of this year looks like, and most importantly, what this all factors back into. And the most important thing that drives markets is earnings. And again, we're going to start seeing earnings getting reported here just in the next couple of weeks. So again, that's going to be a big, important look for that. Here's what you need to know before the bell this morning. Earnings will be starting in about 2 weeks. One of the key drivers that may be allowing earnings in this next quarter, we're reporting the first quarter. One thing that may be allowing for higher earnings, earnings beating expectations has been this rather sharp decline in the U.S. dollar. And that's, has been part and parcel of this outperformance in emerging markets and international markets versus the U.S. We talked about this recently, the outflows into foreign assets, taking away from the dollar. The dollar now bottoming here and beginning, excuse me, the dollar is bottoming here and triggering a buy signal here. So we should start to see some relative strength in the dollar. That's going to help support asset prices in particular. We'll see potentially a reversal of emerging markets and international back into the U.S. In fact, again, we have seen a lot of this outperformance here as of late coincides exactly with this decline in the dollar. Very overbought here, very extended on multiple means, getting a trigger, starting to trigger a sell signal here on international stocks. That's going to likely be exacerbated here if this dollar starts to rally. And again, there's some decent indication here that we're going to start to see some money flows back into the U.S. So this is probably a good time to start thinking about a transition. If you're heavy overweight international, look to start adding some domestic exposure, reducing your international position in your portfolio. But watch this buy signal. If we can get above the 200-day moving average, that probably is going to set up the dollar for at least a decent rally here short term. Again, not overbought yet, decently oversold on multiple levels. Outside of that, also volatility has been one of the big, kind of the big focuses. And we had this big spike in volatility during that 10% decline. Now, I say this big spike in volatility, it was never a volatile increase in the markets, right? So if we go back to that previous kind of correction we had this very sharp spike. This was back in December, and this was kind of that initial concern in the markets over the Fed. And the Fed pausing rate hikes and talking about, kind of they're expecting fewer rate cuts. That caused this really big spike in the market at that Fed meeting. This is the type of volatility you want. This was a very kind of normal increase in volatility during that sell-off. Nothing dramatic, nothing kind of shocking the markets. We've now almost completely reversed that entire spike. The volatility index now back below 20 as well. That's kind of supportive here for the markets also near term. So again, as we start to see volatility decrease, get to see a rally in the dollar potentially, that should help domestic assets begin to perform a bit better. And we've seen that performance here over the last couple of days, particularly back in the Mag 7, which were a lot more beaten up than the overall market. We're starting to see some rotation in the market as well. We had a lot of money kind of hiding out in that value index sector of the markets. That's beginning to rotate over the last couple of days back into the mega cap Mag 7 stocks in particular. Those have been performing better. But outside of that, VIX is getting oversold here. So again, we have some more down, potentially a little bit more volatility decline, but probably going to start to stabilize on volatility here in the short term, at least in the markets. But again, the setup right now is still becoming more supportive for a domestic U.S. rally here, at least in the short term. Again, doesn't mean a return to the bull market, but it looks like for the most part that this recent correction and all evidence pointing to that is over here. So again, continue to maintain your asset allocation, but use rallies, rebalance risk, raise cash, do what you need to do to get your portfolio in line. As I said yesterday, I do not suspect the volatility we've seen recently is gone. But again, we'll just have to navigate this as we go. That's what you need to know before the bell this morning. Come back, pick up with Danny Ratliff, talk about this recession issue a little bit more. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome to the show this morning. Danny Ratliff joining me. Good morning, Danny. How are you?
Morning, Lance. Good.
Some comments in our chat right now on YouTube. I'm talking a little bit about Teslas, and I saw this great video this morning of a Tesla driving down the Houston freeway, and it had Toyota across the back of it. It was a Tesla Cybertruck.
Yeah.
Yeah, I'm going to sneak it in, call it a Toyota.
See, I think if I bought one now, I'd put I bought this after Doge.
Right.
But that'd probably have the wrong effect.
Yeah, probably. Yeah. It would immediately be torched. Yeah, exactly. But anyway, so talking a little bit about recession. This is a topic that Danny and I were going to talk about last week, and I forgot what happened, but we never got to it last week. So
we talked about something else.
I forgot what it was. I've slept since then, so I don't remember what we talked about last week. You have to go to the YouTube channel, look back to last week's show to see what we talked about. But anyway, so we were going to talk about recession risk, and again, just lots of headlines as of late coming out. Recession's on the rise, and we're about to have a recession. And then again, some of this is politically motivated, right? I don't like the administration, so I'm going to write headlines that disagree with him. And there's a lot of that going on right now. A lot of misinformation, wrong information for either unintentional or intentional purposes whatsoever, but a lot of it just politically leaning. So again, we've got to dig into the data to say what's actually going on, what's actually happening. So before we make any type of portfolio moves, that we're kind of working on the right information. So there's certainly some concerns about that. And again, it's interesting because there was this Friday's article is about stagflation. And I went back all through history and I built an index. I said, okay, look, whenever we had real GDP, inflation-adjusted GDP, below 1%, had unemployment above 8%, which is what normally you see during a recessionary type environment, because you have to have high unemployment, and you need and high inflation all at the same time. And throughout the entire history of the U.S., there's only 2 periods where you met those conditions, and both of those conditions were met for a period of about 6 months, very, very short periods, and that was basically the oil embargo, and then the hostage crisis, and it was very, very quick, and then they were over, and then you went back to normality, and so again, but the problem is there's stagflation fills headlines, and it's great for clickbait, getting you to click views and those type of things. But the problem is that they're working on a faulty definition, and they're talking about low growth and high inflation. But what they always forget is the unemployment factor that goes into stagflation. You have to have high unemployment along with high inflation and low economic growth. The problem is that if you have high unemployment historically, and this is going back to 1947, which is all the data we have to work with. The problem with that is that historically, whenever you have high unemployment and low economic growth, you have what? A recession. And what happens in a recession? Prices decline, so you have no inflation. So that's the real crux of this as we go forward. So if we are expecting slower economic growth, which is very likely, and if you're going to have a recession, those are not inflationary backdrops for the economy. And again, so there's a lot of misinformation that gets put out there simply to get clicks and headlines and views and those type of things. And again, that's just the way the media works today. But again, as investors, we have to go back and look at the actual data and say, what's driving our portfolio decisions, and how is this? And again, why does any of this matter? Right? None of this matters, other than if we have a bad situation in the economy, you lose your job. Right? That's the real, bad side of recessions. And I find it fascinating, Danny. There's all these people rooting for recessions, right? It's like if they've got a very bearish tinge to their newsletter or whatever it is, it's like, oh yeah, we're definitely gonna have a recession. Like, why are you rooting for a recession? People lose their jobs. People lose their livelihoods. Their families are destroyed during recessions. Why are you rooting for this? This is not what we want to have happen.
Yeah, and well, I think a lot of people are talking their book, and so somebody mentioned in the chat earlier on YouTube exactly that a lot of times it's that we call it a self-fulfilling prophecy, that we all think that something's going to happen, so we all cut back. And effectively, that if everybody's doing that, shares that sentiment, and usually that happens in recessions. But now we're seeing a lot more with people getting advice from many different areas, where everybody's an expert, right?
Yeah.
How many guys out there that give money advice but don't actually manage money, or who've never managed money?
Right.
And nonetheless, many may not even be able to manage it for themselves well. It's just like those YouTubers back in the day or right when social media was coming out, and you found out that, these people were making all the money. They weren't actually experts. What they were doing is they could garner enough attention to get clicks to make money, but they'd go rent the private jet for an hour or 20 minutes to take pictures, or the Lamborghini or whatever it would be. And so I think we always have to be cautious with narratives. And, that's why we try to follow a very strict discipline from an investment perspective, because we could let our own emotional biases get in the way. I mean, we've talked about that often. You guys wrote something about that not long ago. And, if you look at the recession indicators, consumer confidence is down a bit. Future expectations are well below that 80 number, which signals a recession typically.
Sure.
So, what does that mean? We've been getting so many different head fakes. But you're right. I mean, so many people encouraging almost a recession. And in some ways, I think because markets have been elevated for a bit of time, that, when you look at a lot of valuations, you could argue, okay, yeah, that would be healthy for the market long term. But we could also get something kind of what we're experiencing now, maybe that time correction where we're just trading sideways.
Right. Well, again, there's this, it's, what's the most important aspect of all this, right? When it comes to investing, right? So let's remove everything else out of this for the moment, and let's move this back to just managing a portfolio. So, if you've got money invested in the markets, what ultimately matters is earnings. So how does all of this impact earnings growth and earnings expectations? Because that's what moves market prices. So if the data is suggesting economic recession, then yeah, you want to be very, very cautious about being invested in the markets, because as the market begins to realize that a recession is present, then earnings expectations get reduced dramatically. We get a repricing of markets to meet future expectations for those earnings, those type of things. But this is where potentially people get themselves on the wrong side. They start reading all the headlines about a recession. They immediately jump the gun and start taking action in their portfolios because of this impending onset of recession, because Joe Bob on YouTube said a recession is coming. So now I've gotten out of the markets entirely because I want loss avoidance, right? My emotional instinct of loss avoidance kicks in, and I'm out of the markets, and I'm short the market even worse. I just dealt with an email from a listener that had been listening to another podcast, was convinced that the market was going to crash, and double shorted the triple Qs 2 years ago.
2 years ago.
2 years ago.
Yeah. What's that position worth now?
Well, this is his problem. It's the vast majority of his retirement money, and he's now trying to figure out how to recover the losses. And this is the problem with listening to just general advice and not paying attention to the work and doing the homework yourself. Got himself into a very bad financial situation, and there's nothing that can be done to fix it. In fact, that's something we'll talk about after the break, is accepting losses, right? But there's no evidence in the economy right now that we're going to have a recession. Economic slowdown, absolutely. Repricing of markets for that slower economic growth, that's already been happening. Earnings expectations, they're coming down. The markets are a really good predictor of economic cycles, and they generally lead the economy by about 6 to 9 months. The markets pick up on this data. They're watching this data real time. And so as this data slows down, the market starts to adjust for that. Nowhere in history are you ever going to find that the stock market didn't predict a recession, because they do. They lead it by about 6 to 9 months. The market told you there was a problem coming in 2007 before the financial crisis occurred in 2008. The market was already moving ahead of that. Now, if you waited and didn't pay attention to the signals, you got swept up into the Lehman moment, which is where everything kind of fell apart. But the market's a really good predictor of market recessions and risk and those type of things. You just have to pay attention to what the market's trying to tell you. And that's why we pay so much attention to technicals.
Well, I think even in 08, that year was a challenge because you had, first you had the banking crisis, which started in the spring. And you had Bear Stearns go under in March to May. And then the market actually ran for a bit. And then what was it? September?
But never got to see, this is the thing though, right? You're absolutely right. You had a big correction in March. That was the Bear Stearns crisis. Yep. Then the market rallied back to a new high. It peaked, and then it began to decline. Formed a head and shoulders pattern, broke the neckline of the head and shoulders pattern. This is the technical part. Rallied back to that headline. This was in July. Failed at that neckline. Turned lower, broke that low. That was your signal to get out of the market. And then in September was when Lehman happened. But the market was already getting out. The bear market was already setting in very gradually, letting you know there was a problem well before September when Lehman broke. So just again, if you pay attention to what the markets are trying to tell you, it can tell you a lot about how to invest and about where to allocate your assets. So, all right, come back. We'll talk a little bit about accepting losses. It's a really good. We'll talk about that email I got, and it's a really good point about managing your own money. But it's also a good lesson about having to restart. And we'll talk about that after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, I'm very disappointed in you and Richard, both.
I can't
Very
wait to hear
disappointed.
why.
Because I was online yesterday and got an ad that popped up. And it's for a new book that's just come out. It's called I'm Sorry I'm Dead. That's the name of it.
The Real Investment Show podcast.
You know, so when you pass away, all the people you need to contact. And, we told our kids that when my wife and I pass away, we want them to cremate us and then take us to Italy and dump us in the ocean in Italy.
At realinvestmentadvice.com.
Knowing my kids, I don't trust them. So I may have to have a third party kind of make sure we get to where we're supposed to be.
A trustee of ashes?
Exactly. We got them as far as Galveston.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So since Danny's here, this will be a good time to talk about this email I got because, again, investors typically get themselves in really bad positions because they do extremes, right? It's either all or none. In a lot of cases, like, oh my gosh, somebody said that, the recession's coming, so I'm all out the market, right? Or in this case, even worse, I'm going to short the market, double leveraged, short Qs because, I was told the market's going to crash any day now. Or it's just I'm all in the markets, right? And just disregard, kind of any risk protocol whatsoever. And the problem with that all leads to, bad outcomes in a variety of situations. But I want to talk specifically about this email because the email happens a lot. This isn't the first time that I've gotten an email like this. I've gotten over my career, going back to the .com crisis, going back to 2008. I've gotten lots of these emails over time. Back during the .com crisis, as an example, I just hadn't been working with Brent for very long at that point. Back on that station, got a call from a lady had gone $350,000 into credit card debt to invest in the markets in 1998, 1999. Of course, that all blew up in 1999. She was invested in all .com stocks, et cetera. So now she had, long margin in her account, had gotten blown out of all her positions because of the margin calls and had lost all that money. Now she's got $350,000 in credit card debt. What am I going to do? Those are the stories that you get over time. And we got some of those stories as recently as 2022 during the decline in 2022. Yeah, the market was only down 20%. There was a lot of stocks in the market, all the meme stocks, a lot of the the disruptor stocks and like the ARK innovation funds, those type of things. Those stocks were down 80-90%. So a lot of investors lost just a ton of capital in that environment. So you get these emails, it's like, okay, I did this. And so this particular email was 2 years ago. I was listening to this YouTube channel. The guy says the market's going to crash and everybody's going to lose 50% of their money at least. And so I sold everything and I went double short the Qs. So here we are 2 years later. I've, lost half of my account, more than half of my account. What am I going to do? Right? Well, the first thing to do, and this is the hardest part about this situation, and this is the challenge with investing. Nobody's going to show up and save you, right? There is no saving you from that situation. The only person, my daughter's favorite saying is the best rescue is a self-rescue. The first thing you've got to do is just accept that you made a mistake. This is the hardest part. It's kind of like breaking an addiction of anything. Just you've got to accept that you've made a very bad investment decision. And it doesn't even have to be this. It doesn't have to be this dire. I mean, part of investing is just accepting that you made a bad investment decision. You bought something too high. You bought the wrong asset. Whatever it is, right? That's losing you money. Accept that you made a bad decision. It doesn't mean that you're a loser. It doesn't mean that you're stupid. It doesn't mean you're an idiot. It doesn't mean anything other than you just made a bad investment decision, right? It's like going to Vegas and betting on a weak hand and losing, right? Just you lost some money. Cut it short, right? But in this particular case, you've just got to accept that you've made a bad investment decision. You've lost money. Here's the most important lesson. The value you had was ethereal. It doesn't matter what the value of your account was a year ago or 5 years ago or 10 years ago. Doesn't matter. The only thing that matters is the value of your account today. And this is the hardest part for investors to come to grips with. One of the big mistakes, and Danny will tell you this, one of the biggest mistakes that we see with clients and prospects and everybody that we meet with, they get attached to the high watermark of their portfolio. Right? Danny, I mean, it's like, well, my portfolio was worth X 2 weeks ago. Right? And now I'm losing money. No, you're not losing money. The markets are just gyrating, and the value of your account is going to go up and down relative to the market. So we have to understand that. But there's nobody that's going to come in and get you back to whatever that mythical value was that you've anchored to now. Right? That anchoring is one of our emotional mistakes that we make in investing, and that we've got to get away from that. So, how do you recover from this? Well, the first thing you do is you accept where you are. You sell everything. You go back to cash. Once you're back into cash, you can now reassess your situation. That's the hard part to do. And just saying, look, I've sold everything. I'm accepting the losses. This is where I am. There's nobody going to show up and bail me out tomorrow. There's no magical, I'm going to go hire some advisor and he's going to grow this back to where it was overnight. That's not going to happen. And the harder that you try to make it grow back to where it was, the more risk you're taking, the worse you're going to make the problem. So just stop everything. Just go to cash, take a breath, and then start over and begin a strong, disciplined investment process. And it's going to be a long road, but you can grow your way back to where you were. And we've seen it done in the past. But there's no quick fix for this, right, Danny?
No, there's no quick fix. And I think one of the things that we see often is that we get inundated with so much different information. And then there's people that we like and we follow, and they say, listen, here's what's going to happen. And then it doesn't. And so what I would encourage everybody to do is take a step back. If you're going to make an investment in whatever it may be in, even the smartest guys that are worth millions or billions of dollars, they don't go out and put everything they have into one theme or thesis. Mm-hmm. They say, what can I afford to lose? Right now, they're probably in a little bit different space than many of us, right? That they can go out and they could physically lose something and it would probably be okay. But yet, they're a lot more conservative, where I feel like a lot of times people feel like they have to make up for lost time. Mm-hmm. Like you hear from people, hey, I'm about to retire. I haven't saved as much as I need to. I need to get super aggressive. And my conversation with them is always like, okay, well, great. Maybe we need to be more aggressive on saving than we do on, and cutting spending than we do on investing. And many people don't like that because that's a harder aspect of it. But think about it. And, it's even with short-term money. We have a lot of times we visit with people who say, I'm going to need this money in 2 years or 1 year. Let's go ahead and put it in the market.
No.
Like, no, not at all. Not if it's short-term, not if we know we're going to need it. Because is it life-changing if it goes up 10, 20%? Probably not. But if it goes down 10 or 20, now you have to pull from other resources. Now we're in trouble. And so if you're going out, and Peter on the YouTube channel, so if you're not on there, go to The Real Investment Show, subscribe, like, lots of great chat going and banter going on. But go and think about, what is the actual, you can't put everything in. Unless you have that crystal ball, and if you did, you probably wouldn't be in the situation that you feel like you have to do so.
Right.
So I think this is what is unique in this environment. There's so many experts. There's so much information.
There's too much.
And then we also, though, we let our emotional biases get the best of us. Mm-hmm. And we say, you know what, this is going to happen. Look at all the data. I mean, we do that internally. Don't think that we don't look at all the data and like, oh my goodness, at times. Mm-hmm. But we know what the market's doing. We know that all the different things that can occur. And it is a very challenging market over the last so many years. And we've talked about that. I mean, so many head fakes, so many ups and downs, lots of information coming out, new stimulus, new legislation. It's like trying to plan for taxes right now with distribution planning.
Right.
I'm like, guys, you know what? I would rather you distribute from a taxable account right now and then refill that bucket up at the end of the year, figure out exactly what's going on with this tax code before we do something, or even a Roth conversion, and you can't undo it later down the road. Just with so many unknowns, right? I mean, you have abolishing the IRS to creating only the ERS. Then you have Scott Bessent just a week and a half ago said we're only going to the plan is to only tax income up to 100 after 150,000, right? So you get $150,000 in tax-free income. Mm-hmm. So many things, right? So we could say, hey, I really think this is going to happen. I'm going to do all this now, or you do a little bit at a time, or you wait and see. But from an investing, I mean, we hear these stories all the time, unfortunately.
Yeah, no, and again, there's just, again, as you talked about, there's so many sources of information out there right now. So I mean, you got your mainstream media, right? Fox Business, you got CNBC, you got Bloomberg Television, then you have a billion YouTube channels with everybody on there talking about whatever they're talking about. You've got all these articles that are published every day, financial news sites. I mean, there's just so much it's just information overload. And, it used to not be that way. I mean, we've talked about, back in the days where, you got the Wall Street Journal, it was chiseled in stone tablets, so it was just, it was really hard to deliver and read. But, that was about the only primary source of information that you had access to on a regular basis. And so things just moved a lot slower. And if you really wanted to know what was going on, you had to, get on a horse and go, ride down to the local, Wells Fargo office and talk to your broker, right? I'm being a little bit facetious, but you get my point. But now there's just so much immediacy of information, and it changes so rapidly that what you thought was true 5 minutes ago is not true 5 minutes later. And we've seen that just recently with the tariffs. It's like, Donald Trump just put a tariff on Venezuela, and then the market goes down.
And then tomorrow you wake up and the tariff is gone.
Then tariff's gone the next day.
We're pushing it back.
Exactly.
Yeah.
And that's the problem. So now you sold everything. Now you got to go buy everything back in. That's the problem with this speed of information. That's why we have to, as investors, we need to slow things down a bit so we can process the information as it's coming in and then logically react in our portfolios to that information and what it potentially means for the only thing that matters, which is earnings. All the other narratives, forget that stuff. What does this mean for earnings? That's all that matters. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Danny Ratliff here as well. Got off on a little bit of a tangent this morning, so we'll try to get back on track. But I mean, just some of this stuff is just, I feel like, really important to discuss with you, just because these are the mistakes that we make over and over and over and over again that lead to unfortunate outcomes for investing. And we all have these stories. But again, it's also about making sure that we're keeping a realistic focus on expectations. Because one of the biggest things that Danny and I deal with on a regular basis are expectations. And it's interesting that when individuals show up and they go, oh, I listen to you all the time, I hear you on this channel, or I saw you on Fox Business or whatever, and I want you to manage my money. Their expectation is that we have some magic wand and we're magically just going to be able to take, whatever money they have and turn that into hundreds of millions of dollars for them. And that's just not the way it works. And all our job is to grow your money as safely as possible over time and deal with markets to the best of our ability. But there is no magic wand. There's not, we don't have any inside knowledge that's going to give us an arm up over the rest of the markets, those type of things. It's just we do a lot of work on analyzing markets, economics, all that stuff, tying it back into what all this means for earnings and where those earnings are projected to go. Lots of statistical analysis, technical analysis, all of that. Just trying to understand what the roadmap is for the markets and trying to follow to our destination, right? I mean, that's the end of it at the end of the day. And so expectations need to be well aligned with what you're expecting. And I think one of the biggest problems that Danny, that we deal with is that we don't get told the truth about expectations. Because a lot of times we'll be told, oh, I'm a super conservative investor. I don't want to lose any money. I want to be very cautious. I want to get into the markets very slowly, those type of things. And then the market runs up and it's like, well, why didn't we beat the market? Well, because you told me one thing, but you really wanted another thing.
This is where we could use a degree in psychology more than anything we have in finance. And I don't know that people are lying, so to say. Like, I think it's what they believe at the time, right?
I'm not sure.
No.
This is 30 years of experience. But let me just say what I'm going to say, and then you tell me if you think I'm right or wrong.
Okay.
Because it has to do with psychology.
Yeah,
right?
For sure.
It has to do with psychology. I can go to my wife and I can say, love of my life, princess, sweetheart, tell me what you want for your birthday. I don't want anything, honey. I have everything I need with you. In reality, she wants a new Roomba. I know that already because I get the every time she scrolls on Amazon, all that stuff pops up. And so here's what I'm saying. So let's tie this back to, prospects. Think about, prospect, oh, love of my life, princess. What do you want? Well, they don't want to tell you that they really want a 15% rate of return every year because they're afraid that if they say that they're going to get turned away by the advisor or told that that's not realistic or told that that's not possible. They're going to be told no. And so instead of saying what they really expect, they give you a watered down version of it to be more in line with what they think that you're thinking. Right? And I think that's the challenge that we deal with, is trying to draw out that real answer versus the answer they give to be. And again, this is all of human nature, right? Is that we all want to conform and we all want to fit in with everybody else. So we don't want to say something that may make us an outcast, so to speak.
Yeah.
And so I think that's one of the challenges that we deal with, is trying to get really down to that answer of what the true thing is.
I think it's a little bit different. I mean, I think number one, if your wife wanted something, she would tell you.
No, she won't.
Now,
it's like an Easter egg hunt around my house trying to figure out what she wants.
It's eerily familiar or similar because my wife's the same way. Like she wants a vacuum or something. My dad's like, "You did what?"
I know. I think we're the only two guys on the planet that can buy vacuum cleaners for their wives. And their wives are actually. I bought my wife one of those outdoor wet dry vacs. She was so thrilled.
I had to, a while back, we had to go get like one of those commercial vacuums that, for dogs throwing up and kids stuff. And it's like the best thing. That's like our favorite thing in the world. All right, I'll get it out. You want me to help? No, I got it. Okay.
I know.
Good for you.
We have one of those too. She loves it.
But I do think that it goes in a lot of different ways, right? And I say this because a lot of times we hear this from people who are already clients. And in general, human nature, things are bad, lots of volatility. Take this summer, for instance. People this July, they didn't want to get aggressive. They didn't want to go into buying mode. They wanted to go very, very cautiously. Now, the problem with that would be is that if you step in very cautiously, you look back in December, you say, well, I underperformed. So as an advisor, this is where we have to come in and say, listen, here's what we think. Here's why. You feel this way, completely appreciate it. However, and we're happy to go in and step into the market. If the market runs, we're going to underperform. Are you going to be okay with that? If the market takes a nosedive, look, you're going to have more capital on hand. That'll be great. We can meet in the middle here, but we have to be realistic about this. And I think that is one of the things that when things are really good, everybody wants to get in. It's just like all the people for years. How many people do you think we have call every year up to 2020? It says, I've been out of the market since 2008. I need to get back in now. In 2018, 19, 20, this was like, almost every other day. At least it felt like it. So we missed out on all that, but now we have that fear of missing out, need to get in. We had a lot of those conversations about FOMO. And on the opposite end, especially when we're hearing so much negativity, so much information is coming out, and we say, oh my gosh, you know what? I know I want to get in, but I don't want to take much risk. I want to step in slowly. And so I think what ends up happening inevitably is, like you said, though, is that look, they felt that way until the market went up. And so it's that recency bias.
Right.
And then the market goes down, everybody wants to be out, and we forget about any returns that we've made over time. And so with the speed of information, it's made it a much greater challenge for advisors, but for especially investors in general. Because listen, and I appreciate, and I tell everybody this is your livelihood. This is what you've worked for. Especially if you're retired, you want to make sure that you're providing for yourself, your family, your future. I understand it. But sometimes we let the emotions get the best of us. And, that's why we go back and we spend so much time on a plan. We understand what type of losses that you could incur. We understand, the different disciplines that we're going to utilize to either remove risk, to add exposure. And it's not for everybody. But you need to take that kind of dispassionate approach to your money. And I think what you mentioned earlier when you talked to somebody about, I am so convicted, the market's going to go down, they go short the whole market. Mm-hmm. And on the flip side, you see the opposite too. Hey, I pushed all the chips to the table. So I think when you think about any individual investment or any investments as a whole, you need to understand, what is my potential for loss? If it's in a diversified portfolio, can you go down 30, 40, 50%? Absolutely. Will you, if you're actively managing it with some rules in place? Probably not. If you're diversified and you have other investments, you're not just all in stocks or all in one specific area, the likelihood's beginning to go down much more, right? We can go back in history and look at a lot of different data that suggests that you're not going to face the full extent of the market unless you're 100% invested in SPY, QQQ, whatever it may be, or you're highly concentrated. So we sometimes have to get out of our own way. What I found interesting is as the market was down, from its highs, a lot of people say, I am down so much. And I'd go back and look. I'm like, you're actually up for the year. But I think we get so caught up in the headlines, that's all we think about. And then we look at it from day to day and think, oh man, this stinks. And it does. Nobody likes I don't like seeing red. Lance certainly doesn't like seeing red. But it's part of the, Richard would say this is the price of entry to the market. We have to expect volatility. And we've been discussing, we'd probably see a lot more this year.
We do.
So what does your plan allow for? What type of downturn can you actually take and not miss out on the goals, the things that you want to accomplish? And that's where I think people get it wrong a lot.
Right.
Is that we forget about what is the intent of this money? Can I reach all the goals, things that I want to do, pay all my bills? If that's the case, okay, we've got to understand it and put it in perspective. But I think we forget that part so often.
We do, and because we get blindsided by all the media. Market was up this much today.
Yeah.
Markets are going to the moon. It's off to the races, and we just start, instead of focusing on our goals of what it was we were trying to invest for to begin with, we get into chasing the markets, right? We just want to get more and more returns. Like, oh, I need to make more. I need to make more. And it's just the greed factor that settles in. And we're all, human nature is, all based on fear and greed. And that's why Las Vegas does very well, because you like to gamble. You go to Vegas, you gamble in the hopes that you're going to win a lot of money. You lose most of the time. Vegas wouldn't be like it is if it wasn't based on losers, and they need losers to come in and spend their money, and that's what keeps Vegas, very wealthy. And that's why when I go to Vegas, I have an ironclad lock bet that I make. I only play roulette. I bet equally on red and black every time. I never lose.
Genius. Sounds like a really good use of time.
That's why I never go to Vegas.
Do you at least get free drinks?
No. That's why I never go to Vegas. I can't stand losing $100. So it's just, there's no reason for me to go to Vegas because I just don't like gambling. I gamble enough every day in the markets with other people's money, which makes me absolutely nauseous sometimes.
And your money. I mean, you're invested alongside.
Yeah, of course. You know what, though? It phases me less when I lose money in my portfolio than it does when money gets lost in clients' portfolios because of market. That weighs on me way more than my personal money.
Yeah.
So anyway, markets, futures pointing up a little bit this morning. Looks like we're trying to get a little bit more of a carry through. Been rallying for the last 3 days. That's all great. We'll see where this takes us. Articles out this morning on the website, realinvestmentadvice.com, our daily commentary. And then that article on stagflation coming out on Friday. Realinvestmentadvice.com. Join us, like, subscribe, the YouTube channel. We appreciate you. We'll see you back here tomorrow with Michael Leibowitz.